Okay, it looks like we're ready to go, and thank you for joining us. As usual, everyone but James and I will be muted until we get to the Q&A, which will be 45 minutes from now. And we do have a very unique guest today. And the reason I say that is that unlike almost everybody that we have on these webinars, James actually manages money. And moreover, he does so for some of the most influential people on the planet. James epitomizes cool. He's also, as you're going to soon learn, extremely articulate, very bright, but he's also one of the nicest people I've ever met. So don't let your head swell too much there, James, but you deserve all those accolades. So uh, thank you very much. I know how busy you are. So
It's all good.
taking time to join us today is a great honor.
Well, I thank you. Thank you for that overly generous introduction, David. And what a thrill it was the other day to meet you, to meet Jeff, to meet Mark, and hang out with mutual friends who we shan't name for obvious reasons. But a great day, a great conversation, and how nice that we're now able to do this follow up. I can't wait.
Absolutely. Well, again, thank you. And I'm just going to try to get back to the slide deck here.
Uh-huh.
All right, so I told James we wanted to spend a little bit of time. Uh, okay, Mark, let's take it to the next one. So, actually, this is almost my Adam Taggart lead in here, where he asked, what's your current opinion of the financial markets and the economy? But kind of this big picture thing, and then we'll zoom into one of the areas I think you're most interested in. I am certainly, which is Japan and its currency. But what are some of your favorite, strategies and moves that you're planning to implement next week, to the extent that you can, next year, to the extent that you can talk about those?
Yeah, no, happy to do so. And let's start at a high level with a little bit of investment philosophy. And all I'm trying to do is be less wrong. And I know I say that all the time, but it's easier said than done when there's a lot happening out there. But part of the objective of being less wrong is to not focus on everything that's changing, because there's a lot changing all the time, day to day, week to week, month to month, prices up, down, sideways, and so forth. We all know that. I think part of the challenge is to focus more on what's structural and what actually isn't changing. And to take an extreme example of that, there's a man named Bezos who built one of the world's most phenomenal businesses that we all use every day. And the success of that business, as he often says, is predicated on him, Bezos, understanding a long time ago that human preferences don't change. They don't change. And who knew, David, that we all absolutely needed one-click shopping, but we generally like convenience. And at the end of the day, we're all quite lazy and simple people. And Bezos made a hell of a business out of that. And look, it may sound like a stretch, but investing's no different. There's all sorts of things that are changing all day long. People get wound up about this, they get wound up about that. But the key to success is to try to focus on things that are likely to be structural, investment trends, themes, and so forth. And structural trends that you can say with a high degree of confidence, better than 50-50 odds, which is good, are likely to be around for some years to come. And then hopefully we can allocate capital to that. So unsurprisingly, when I look at the world and the United States in particular, I take the Trump administration at face value, believe it or not. And very obviously, they're just getting started, embarked on a project of national resilience, which, as you heard me say the other week, I describe as a Manhattan Project 2.0. And it's very high risk. They know that. It's very high risk because all the spending that's going to come might yet push inflation up. It might trouble the bond market. It might, all these sorts of risks. They know that, but they feel they have no choice. And they're just getting started. And for those of us outside the United States who greatly admire your country, for better and worse, through thick and thin, what we don't often see is the entire financial, industrial, and entrepreneurial might of the United States all lined up and all pointed in one direction, as it is right now. So AI and all the excitement there is one subset of this national resilience project. Rare earths is another subset of this national resilience process. Defense procurement, everything else. It's all about national resilience and Manhattan Project 2.0 is the way we should think about it. Now, to be very clear, it does not mean building a second bomb. Let's not be negative about that or pessimistic.
We have
It's
plenty of
about
those.
Yes, yes, happily. It's about the whole financial, industrial, and entrepreneurial power of the United States all being lined up in one direction. That, to me, is the structural theme for the next several years. And believe it or not, there is bipartisan support for that. So I start everything there, as again you heard the other week, and then we try to think about how do we participate in that? Are there assets out there, companies, bonds, stocks, you name it, and of course commodities that we can own at a reasonable price with a margin of safety, ideally, and generate reasonable expected returns over the foreseeable future, no matter what's happening in the world? The answer is, of course, we can, and of course, we should. And that, to me, has been one of my big challenges working with my clients over the last 6 months, getting them to look through the fog of all the headlines, the tweets, the comments, the disruption, and focus on what is not changing. And it's been a challenge, but slowly, steadily, my clients are moving around to that mindset and acting and deploying capital accordingly, which is a good thing. So for me, David, it starts there. That's to me is the essence of what's happening. How do we participate in the United States national resilience agenda? And then around that, it's understanding the pros and cons and impact of that on the rest of the world. And then further down, you've got special situations such as Europe, the UK potentially, China, of course, Japan, which I know we're going to come to, and then trying to figure out who are the winners and losers, who are capital and commodity exporting nations, who are importers, so on and so forth. So that's a very, very broad sketch about how I'm thinking about the world in 2026, and I hope that makes a lot of sense.
Well, thank you. And actually, you had a phrase in there which I think is really critical that's often overlooked when investors are trying to make these structural, long-term secular plays, and that's reasonable price.
Yeah,
What I
yeah,
find is so often, the story makes total sense. And of course, AI is a great example of that right now. But a lot of
yeah,
times the valuation paid is so high that it makes it very difficult to make money and very easy to lose money.
yeah.
So
So
I think that's so
let's think
essential.
about that. Yeah, let's think about that. There's an awful lot of people who want to chase AI momentum, and we get that. There's a lot of excitement around it. The funding liquidity is coming in. Some people would say, and I don't disagree, it's a kind of perfect marriage of Silicon Valley evangelism with private credit dry powder. And there's synergies there. People are happy to lend against GPUs. They're happy to lend to data centers. The funding liquidity is right there. What's even more interesting over the past couple of weeks is you're seeing a bit of a reappraisal, and I'd argue it's long overdue. So you're seeing a derating of the open AI complex and people suddenly discovering that Google's got some good things going on. So the capital is shifting. It causes turbulence in markets, but that move away from the Benjamin Graham voting machine to some kind of weighing machine is actually a healthy development. And as much as the OpenAI complex is a little on the back foot, the Google complex is in the ascendancy. But in aggregate, the AI juggernaut keeps rolling on. But no one says we have to play, right? And going back to this theme of national resilience and Manhattan Project 2.0, I mean, for many decades, we've run the world to optimize for globalization, or at least we did pre-COVID. Optimize everything to within an inch of its life, as humans do with every system, maximize profits, rinse, repeat, rinse, repeat. So the whole world was just in time. And now we're in a world which is more about just in case. And that's been slowly unfolding for 5 years. So resilience in supply chains, resilience in portfolios, liquidity buffer, all this kind of stuff, all of which has a place, but it's hard to make that transition. And if we're moving from a world that was all about optimization and taking it to the edge to more just in time, it's going to be expensive. It's going to require sustained investment. And we're basically directing capital to important chunks of not just domestic, but global economies in which we've systematically underinvested for decades because, frankly, we didn't care. We were not incentivized to invest in excess inventory or everything else. Everything was run really lean. And for investors, this is fascinating because you've got all these eyeball catching, high flying NVIDIAs and OpenAI, all that kind of stuff, the CoreWeave up to Door East. You've got all these things that are getting all the limelight, and that's exciting. And maybe there's not much margin of safety. In fact, I don't think there's any margin of safety at all, but that's okay. But to power all of this, obviously, we're going to need a lot more capacity across most of the commodity complex. And for decades, we've systematically underinvested in the commodity complex. And on top of that, we had this disastrous experiment with ESG, which cut off funding to so many of the essential ingredients and materials we now need to build out national resilience. And for investors, to get back to my point, forgive me, but for investors, it's super interesting because some of the biggest beneficiaries of national resilience, of course, there's going to be private defense tech and everything else that are going to be winners, and they're hard to access. There's going to be winners across the AI complex as much as there are users. There's all of that. But really, to me, to state the obvious, it's all about commodities, and particularly commodities where the supply side has been starved for decades. And when you have people start to reallocate to sectors that have been starved of capital and funding for decades, all it takes is for one or two important people to push a button. And what they think is not a consequential amount of money going into the commodities complex or a commodities stock or the underlying commodity itself can have enormous impact on the underlying market as these allocations come in. And frankly, what we've seen in gold over the past 3 years, I think, is a metaphor for what's going to happen across the entire commodities base. You're seeing copper make a new high this week, which is intuitive. But you look at aluminium, you look at platinum, you look at the rare earths, of course.
Some people, he's talking about aluminum. He just has a little bit different way of saying it. He says schedule instead of schedule, but that's okay. We get
it. That's right. We can do Google Translate on this when we send it out. But look, you see the point here. All it takes is for one or two key players to wake up to the associated structural opportunity across the commodities complex, and it can have a really dramatic impact on the underlying asset or the underlying business. And the fancy pants phrase you've heard me use is the inelasticity of absorption. Now, if any of us wanted to put $1 billion worth of savings into XYZ mega cap stock, look, we could do it. It might take a few days. We maybe even do it on a single day, but we could do it. Putting $1 billion into a commodity company that has a market cap of $1 billion is by definition a little tricky to do. There might be some slippage. But again, I wonder, and I'm not saying it's a fact, but I wonder if what we've seen in gold, where sticky capital decides they want more of it, and whatever people say, gold might have a large market cap, but it's still not terribly liquid. All it takes is for global capital to push a button to reallocate to important, systematically underinvested markets, and it can have a dramatic outsized impact on that asset. And that is what we're starting to see across the commodities complex. And just whilst I remember, this is a really high level view, but sometimes you can learn a lot just by stepping way back from the Bloomberg and just eyeballing numbers. I do that a lot. I just look at numbers a lot. And isn't it interesting, David? I think we'd all agree that the Chinese economy has not been great over the past couple of years. In fact, it's been very sluggish indeed. And in cycles past, if the Chinese economy was sluggish, the commodities complex would have been belted, absolutely belted. Didn't happen. And in the context of what has been one of the worst 18 months for the Chinese economy in many, many years, the fact that commodities generically did not make a new low in 2024 and have not only dug in, but in many cases made new highs in 2025, I think is a hint at the inelasticity of absorption as the funds start to flow to these essential sectors well beyond power, the commodities themselves. And I suspect that's all a taste of what's to come.
Well said. Good stuff. So I know there's people on this. I believe Robert Mullen's joining us. He definitely would have this thought foremost in his mind, which is from all you're describing, what are the implications for inflation in the United States?
Look, let's be clear. There's a 6 month window here where everyone might get away with it. And I say that because, look, we all know inflation is still well above the Fed's target. In fact, it's well above most central bank targets. But just on that, if we face, or central banks or policymakers face a hard trade off between meeting a 2.0 inflation target and national resilience is going to win every time. And implicitly, that is what's happening right now. So the Fed's trying to talk tough, for example, and say, oh, well, it's a bit above target, but long-term inflation expectations are anchored. Yeah, okay, fine. So we feel we have room to cut. Yeah, okay, whatever. So implicitly, we're foregoing a binding 2.0 inflation target, and we're sacrificing that for national resilience, which frankly is the way it ought to be. But for the next 6 months, they're going to get a bit lucky, I think, because for mechanical reasons, I'm not saying that the inflation we all feel is diminished. It is real. But for realized inflation indices, we probably get lucky for another 6 months in the United States because rents are coming down. I mean, I work and you work with a lot of people who are very big in the North American real estate market, and rents are starting to come down. Rents, as we all know, are a very large component of the overall headline inflation indices in the United States, and they come through with a lag. So if rents are coming down a bit today, it'll show up in the overall inflation data with a 3 to 6 month lag. So we know that's in the pipeline. And it is actually possible that as we move through the first half of next year, headline inflation in the United States actually starts to come down again, aided in addition by gasoline prices that are generally under control or lower. So they get away with it for 6 months. But you are, of course, asking the question that we get everywhere, which is how do we get away with it? We're committing to spend unlimited amounts of money on national resilience. We're committed to financing all sorts of power and energy and electricity transactions in a way we haven't in decades. It is the ultimate whatever it takes. There's no stopping us. The United States is going to lead the charge. Other nations are expected to fund that or to do more domestically on their own, buying from US defense, whatever. If the whole world is going to spend more with inflation already sticky above target, then how do we not even get more inflation? And I think the probability is sometime in the second half of 2026, inflation becomes some kind of binding constraint. I'm not talking that we go from 2.5 to 3 to 5.5 and 6. I'm not talking a rerun of 21, 22. But I think what we're all actually asking, David, is not the inflation question per se, but when does inflation come back in a way that means the Fed can't cut anymore, and what are the consequences of that? So for me, we've got a 3 to 6 month window of opportunity here where the Trump administration can get away with it, where inflation is still uncomfortably sticky but not getting terribly worse. But my best guess is the second half of 2026 might be when things get a little bit more difficult, but we shall see. None of which, by the way, diminishes the idea that we should be looking to structurally align our portfolios with this concept of a Manhattan Project 2.0.
James, do you know Vincent Deluard with StoneX in San Francisco?
No.
Vincent Deluard. Well, the reason I bring that up, a number of our people on here have read his newsletters because we've relayed some of them. He's a good friend. And the reason I bring this up is that he just put out his most recent note, and he's saying basically the same thing, that there's this 6 month window
Yeah.
where there's enough slack that the Fed and the administration can get by with this easing process before the inflation cycle or trend, worsens from where it is in a meaningful way. Now, you could say it's already
Yeah.
not good and it's already understated. I believe that. I think it's probably running closer to 4%, but regardless, it's this idea that, we there's trouble coming, but not yet, which I know that's kind of frustrating to a lot of people that want to know, when is this phenomenal asset of inflation that we've had for, well, certainly since COVID, but even going all the way back to 2008 at the bottom, or early 2009 at the satanic low of 666. I think that was early March of 2009.
Yep.
So it's been, well, I mean, what are we now? We're up a factor of 10 from that. It's
Yeah.
just, I don't know that there's ever been a period of time in the stock market where we've seen that kind of appreciation that's lasted so long and with so many problems. I mean, it's
Yeah.
not like the United States is where it was in 1999, where we had, of course, a big bubble. Now, I would argue this one's even bigger, but that's up to debate. But what's not up to debate is that the fundamentals of the United States were much better then than they are today. So that's
Yeah.
a major divergence. You may remember that Alan Greenspan was moaning to Congress in around 2000, 2001 that he was before the terrorist attacks. He was afraid there would be no treasury bond market by 2010 because the government would have paid back all its debt. And of course, today that just seems like like from a different galaxy or dimension. But anyway,
Yeah.
so that's good stuff. And I guess a question that I have for you, and feel free to say I can't respond, is are there specific areas? I mean, whether it's a specific commodity, you mentioned aluminum. I mean, are specific equities and commodities or asset classes, style sectors that you think are a particularly well positioned for this national resilience effort?
Yeah. And there's one country in particular that is extremely well positioned, but most people have kind of forgotten about it, and that's your northern neighbor. Now,
Canada.
of course, the Kamikos and others have done well. I mean, anyone who can fog a mirror knows that. But there's an enormous bunch of stalled Canadian resources projects that are now going to get accelerated. And what the Prime Minister, Mr. Carney, announced last week with someone who everyone thought was his mortal enemy, Danielle, I should say, Smith, who's Premier of Alberta. Their MOU about energy and climate and everything else was a very tricky thing to negotiate. And a lot of people I know rubbished it, which I think is a huge mistake. And when Prime Minister Carney says Canada first, he means it. He knows that Canadian citizens are still furious over the way they've been treated by President Trump. He knows they will give him the benefit of the doubt, even if the politics are difficult. But he's in the process of undoing all Trudeau's massive, massive damage to the Canadian economy, while simultaneously addressing all these colossal inefficiencies that exist in intra-provincial Canadian trade, energy permit, the whole thing he's looking at. So Canada's, I mean, there are some great businesses that have done well, but there's a whole bunch of other companies that are less well known that are going to do really well as the permitting accelerates. Now, look, everyone on this call knows that the Canadian economy is struggling right now. There's no denying that. There's no denying that. Confidence is down. The housing market is a lot softer. We all know that. But if I'm roughly right about the Manhattan Project 2.0 and what that means, not just for the United States, but all the spillovers on North America, Canada's going to be dragged along for the ride. So I would encourage people to look at some of the smaller Canadian resources companies and to understand if there's opportunities there, because I think the answer is plenty. And alongside that, I think the Canadian dollar over a long period of time is going to do pretty well relative to other countries. So I'd actually start with your near neighbour. And
So
beyond
to that
that,
point, just want to interject on an area, a sector that might be worthy of people checking out, and that's the Canadian natural gas producers. Natural gas in
oh
the
yeah,
U.S. has been one of our better commodity calls over the last year plus. Some of the equities have moved a lot, some have moved a little, but natural gas in the U.S. for January delivery just hit $5, and it
right.
was, 250 or so back September last year. But in Canada, natural gas still trades extremely inexpensively relative to the rest of the world. And they are putting in
Yeah.
more takeaway pipelines, basically. Are there any Canadian natural gas producers that you think are particularly interesting that you can talk about?
I haven't looked at the Canadian natural gas producers specifically, so I'll defer comment on those.
Okay. No, that's fair. Uh, we've got a few that we've got in our hopper that we might, in fact, I've mentioned it in the past, but we'll probably come back to that. But because I totally agree with your point, and I just think that natural gas, with what's happening with LNG and also what's happening with the data centers, that natural gas demand is going to be tremendous. And as
Yeah.
an example, what you've said, it's just very, very difficult to develop these natural gas
Oh,
reserves,
yeah.
even in the United States, where there are people that say we have, indefinite, limitless, boundless amounts of natural gas, and not quite true, but it's certainly at a higher price. You do make, more reserves recoverable, and $5 certainly works in the United States. But those poor Canadians, I mean, I saw not too long ago that it was trading, around $1. And I think it depends on what market you're talking about. Anyway, we don't want to get too specific.
No, but there's change afoot, large structural change afoot. Too many people I know had pigeonholed Mark as Carney as some kind of environmental warrior and this, that, and the other. And what we're rapidly seeing emerge is the ruthless pragmatist I know.
Okay, well, Mark, let's roll it here. Because we do want to get to Japan here pretty
Right.
quickly. We're getting a little bit on time. So this actually, James, is from your Aussie buddy. I say buddy.
I recognize that
Do you
chart.
know Gerard? Gerard Minnick?
Oh, of course, we're very
Okay,
good mates.
good.
Yeah.
He's one of my favorites. And so
Yeah.
he's got several, he just published this note because there is a lot of negativity on Japan, and we hear about how they're just drowning in debt. And then there's a difference between gross debt and net debt, which obviously looks a lot better. And, maybe you could argue the net debt's too flattering, but what we do know is Japan owes virtually all that debt internally. So
Mm.
let's go to the next one here, and we'll see another rather comforting slide. And this, of course, has to do with the radical difference between Japan's export surpluses and the U.S. in terms of being in a major trade deficit situation. And actually, if you look at it on a cumulative basis, the U.S. is now the world's largest debtor country, whereas Japan is the world's largest creditor country. So I have a hard time buying this really bearish argument on Japan. We've got a couple more, I think, coming up here. Interest paid, I mean, obviously their interest rates have been so low for so long. And of course, that's fed the carry trade, which, once I go through this a little bit further, I think we should discuss whether this carry trade's at risk of unwinding like it did in the summer of 2004. Clearly, the yields are moving up a lot, particularly at the long end, but at the short end, not so much. We still have the policy rate at 50 basis points, right, James? BOJ, Bank of Japan.
Soon to be high, but
Soon to be
yes.
75, which is an interesting flip because it was just like last week. The odds were that they were not going to raise. Now all of a sudden, the expectation is they are going to raise. As I think you heard me say in Augusta, I do believe that if Japan, if your friend Mr. Kuroda does allow interest rate, or he's not in a position of power anymore, but he believes, and gets some pretty good contacts, that it's going to hit 2%. So the Bank of Japan's ultimately going to raise the short-term rate, their policy rate, to 2%, which I would believe would be very stimulative to the Japanese economy because it's such a savings-rich country. Basically, it'd be a transferal of wealth from the government to the private sector, which Takaichi, the new prime minister, would like to do. She wants to stimulate, and it would also stabilize the bond market, kind of cool the inflation fears. I think the Japanese population, for the first time, let's go to the next one because we have a visual of well, that's their interest, still very low. Maybe one more. I'm remembering right. No, I'm not remembering right, but this is looking at the yen. But if you look at their interest rates, the yield curve is unbelievably steep, and they've got an inflation rate that is now bothering after years and years of flirting with deflation. The Japanese population is increasingly concerned about the higher level of inflation.
Yeah.
So I mean, what do you see their action steps, and will that, trying to solve the domestic problem, will that trigger a breakdown of the carry trade?
Look, it's a super interesting conversation, and like so many topics these days, too many topics, the amount of nonsense written recently on Japan, JGBs, not to mention the Fed's balance sheet, reserves, repo. I mean, nearly all of it is garbage. And suffice to say, markets continue to function. So that's the first point. On Japan itself, it's really fascinating because it's impossible, theoretically, for them to ever have a fiscal crisis because to avert it, they could repatriate all their foreign savings, which I hope they don't, because it'd be a very difficult day in global markets. But you can see the point I'm making. Per Gerard's charts, the one great advantage Japan has in its favour is an awful lot of foreign assets, some of them hedged, many more unhedged, that they could repatriate in a crisis to make themselves whole and keep themselves going, but they don't really want to do it. So that's the first point. The second point is Takaichi's come into power just. She has no strong mandate, but she has approval from Trump to try to make Japan great again. So they put forward a supplementary budget, which they knew was high risk because the JGB market was on the back foot. I mean, everyone knows that. And they know that they're a little bit short on policy credibility and they're trying to fix it. Now, sequencing is very, very important. It is often said that central banks are independent. Well, yeah, central banks are independent when it comes to setting monetary policy, but they're never, ever, ever independent of government, let alone politics. They're not. It would have been ridiculous to expect Ueda-san, the governor of the Bank of Japan, to signal more rate hikes, even though he wants to, before the Japanese domestic politics had sorted itself out and before Takaichi had passed her supplementary budget, which she did. So there's going to be additional JGB borrowings over the next year. We all know that. The market had adjusted. But what is so clever about the Bank of Japan over the past 3 weeks is while everyone's got their hair on fire about policy credibility, the Bank of Japan's secretariat, which controls the rostering of all their speeches, has put out heretofore dovish members of the Bank of Japan's Monetary Policy Committee to send very hawkish signals about what the Bank of Japan has to do with interest rates. And what's interesting is
that's interesting. I have not read that anywhere. That must be a very, at least in the West, very uncovered.
Yeah. So the speeches are out there. They're in the public domain. But the method, why are these people being given the opportunity to speak now? Because they're trying to not convince markets. They're trying to convince Takaichi and her team on the absolute necessity of more rate hikes from the Bank of Japan at a time when inflation is high in Japan, real rates are very low, which is absurd, and the Japanese electorate is still quite wound up about higher prices. If you're trying to restore credibility, which they're keen to do, the Bank of Japan must keep hiking, which Ueda-san agrees they need to do. You therefore anchor long-term inflation expectations, which should serve to calm the long end of the JGB market down. And unsurprisingly, David, to your opening point, it's an unusual combination when the Bank of Japan is hiking and signaling they may have to do some more at the same time the Fed is cutting. You don't often see that, but we're going to see it for at least the next couple of months, maybe 3 months, maybe 6 months. I don't know.
But, yeah, but that's where this chart comes in that we have up here right now.
Right.
So just to refresh for everybody that's watching here, James doesn't know this, but this means the yen is going down. So this is taking more and more yen.
Hang on. It doesn't mean anything. What it does mean is that there is a window here, given divergent monetary policy paths, for dollar yen to go down. Nothing's given. I'm just being pedantic. Nothing's given in finance. But if there was ever a window for the yen to rally and the dollar to go down a bit, the window is right here when you've got the Fed cutting, the Bank of Japan hiking, 155, 154, 155 should be something more like 150. Now, let's be clear. There's definitely a trade here. There's a trade to be done. And it is well within the power of the Takaichi administration, Ueda-san, etc., to calm down the JGB market, to calm down the yen and demonstrate their credibility. They have the power to make this all calm down. And also, whilst I remember, today there was a 30-year, or earlier today in Asia, there was a 30-year JGB auction. And the usual hair
That's for
on
Japanese
fire,
government bonds when he says JGB.
Yeah, and the usual hair on fire community who all believe we're going to be hit by an asteroid in every direction said that, oh, this would be a failed auction, usual rubbish. You had the highest bid to cover ratio in today's JGB auction, 30-year JGB auction that you've seen since 2018. So the point being, there is demand out there for JGBs if the Japanese authorities are prepared to demonstrate credibility, which allows them to muddle through. And quite frankly, they don't mind the fact that the JGB curve is as steep as it is. But to describe what's happening in Japan as some kind of catastrophe or everything else is just not true. It's not true.
But that's
So
the way
where,
the yen's trading.
what's that?
But that's the way the yen is trading. It's trading. It's very. I mean, it's testing its multi-year lows. It's 40 to
Three,
50% undervalued versus the
three
dollar.
weeks ago it was. Three
It's
weeks ago,
rallying. It has rallied a little bit. It has rallied a little bit. That's true, but it's
yeah.
still very,
and
very
un, and
depressed.
that's okay. And I haven't forgotten your earlier point about the carry trade, which is where so many of their commentators are just so wrong. Once upon a time, the yen carry trade, a Tiger, an LTCM, they had huge yen funding positions. And at the start of Abenomics, there were some enormous hedge fund positions, short yen, long dollars from around 80. In fact, one of the biggest was a man named Besant, and he made an absolute fortune out of that, which people have forgotten. But if there is a carry trade today, it's not levered market participants. And I don't know why people keep saying, I don't mean you, but there are people out there who say, oh, the yen carry trade is massive. They're just not thinking straight. There is very little hedge fund participation in the so-called yen carry trade. The true yen carry trade is Japanese institutional investors who, quite rightly, over the past several years, have put more and more dollars to work, or sort of say yen to work overseas, some of it hedged, a lot of it unhedged. And unsurprising, the rolled up gains on those exposures, the profit is enormous. So look, at some point they might all decide to sell, but there's no incentive to sell if the underlying US asset performance, especially US credit, continues to be so strong, which it is. So I know this is a pedantic point, but I think it's extremely important.
It's an important point, and it's one that our partner Louis and my great friend Louis Gav has made a lot too. That it's
Yeah,
really the whale in that market are the Japanese
yeah,
institutions, and to a lesser
yeah,
degree, Japanese households. The
yeah,
infamous Mrs. Watanabe.
yeah.
Okay, good point. Yeah, good point. But
So,
I do
so
believe over
unsurprisingly,
time we're going to see the yen
unsurprisingly,
perform much
Louis,
better.
yeah, unsurprisingly, Louis as always is much more sensible and proportionate and on the money compared to all the hair on fire community. But the point is this: the asset allocations that have driven so much of the outflow from yen savings into the rest of the world, into US assets in particular, these are not things that get changed very often. In fact, they're rarely changed. So they might trim their hedge time to time, and they do. And there's scope for dollar yen to come back a little bit to 150 and so forth. But I don't see any evidence at all that any of these great big Japanese pools of capital are about to evacuate US credit or treasuries or anything else you care to imagine, or tech stocks for that matter. There's no evidence of that. But to be clear, not to avoid your question, if you're thinking that there's room here for the yen to rally, I completely agree. I'm not sure how far it goes. Maybe it's a 5% rally, but that's no bad thing.
At this point, I take it.
Yeah.
Okay, so
Yeah.
we're getting close to Q&A time back. We're maybe a little bit behind schedule here, but let's keep going and just see if there's
Sure.
anything that you really want to. So I guess this is because I was listening to Tom Hennig on Adam Taggart's podcast here recently. He's a former senior Fed official. He was president, I think, the Kansas City Fed. One of the
Yeah.
Midwest Feds. I could have that wrong a little bit, but
No, that's
he
right.
believes we're moving into fiscal dominance. And it seems to me that given your scenario of investing heavily in national resilience, this is quite likely. And I don't know if you know this acronym. I just came across this. So I think this is from Stephen Mirren, this RMOP, Reserve Management Operation Purchases, which some people believe this is basically unveiling perma QE or setting the stage for permanent quantitative easing. Have you seen that? Do you have any thoughts on that? I mean, is it just another example of how the Fed and the Treasury are both going to be in a reflationary, fiscal financing mode without regard to price stability, at least long term?
I've often wondered what fiscal dominance actually means, because there seem to be a whole range of definitions. But what do you think fiscal dominance means, David?
Well, I think it's a set of priorities. As you know, the Fed has got supposedly two mandates, but these mandates continue to expand. And I think one that's becoming increasingly important to them is making sure that the Treasury market stays functional. And
Oh
maybe
yeah,
it's a stealth way of saying fiscal dominance, but well, how would you define that?
I think the drama queens amongst us, of which you are not one, happily, the drama queens amongst us would say fiscal dominance is where the United States gets itself into an impossible situation whereby the private sector refuses to buy any treasuries, no matter what the yield, and therefore the Fed is compelled to underwrite every treasury issuance, its yield curve control with obvious consequences and results. So I think a lot of people are skewed towards fiscal dominance as being justification for owning everything from crypto to gold to everything else. It is therefore extremely interesting to read carefully what Scott Bessent is saying, what Mickey Bowman is saying, and what, yes, Stephen Myron is saying. It's really different to what most markets are thinking. Now, understandably, as a result of recent plumbing congestion, repo markets, balance sheets, and everything else, there's been a whole community of people have said that the Fed must now do this, that, and the other, must expand their balance sheet, or something's going to blow up somewhere. It's therefore a little bit disconcerting, I'd imagine, for those people that despite ongoing repo congestion and volatility in repo financing rates, that markets continue to perform well. They're working well. No one is degrossing, delevering, or anything else. It's quite remarkable because guess what? Every sophisticated interest rate trader on earth may be reliant on overnight repo for financing, but there are unsurprisingly ways of hedging some of that gap risk. So they do. Now, as much as people anticipate with September 2019 firmly in mind about too little reserves in the system, that the Fed, if anything goes wrong in the plumbing, the Fed must expand their balance sheet. And you've got John Williams at the New York Fed, you've got Laurie Logan at Dallas, you've got Beth Hamack at Cleveland, all saying, oh gosh, we've hit the lowest level of reserves, we're going to end QT, and everyone says, we know what comes next, they buy assets. Bessent, Bowman, and Myron are saying the exact opposite. And people have either not bothered to read what Bessent, Bowman, and Myron are saying about the Fed's balance sheet going forward, or are pretending they're bluffing. And I can tell you when Bessent, Bowman, and Myron all say the Fed should have a substantially lower balance sheet going forward, they are not bluffing. They are not bluffing. When those three talk about this conflict between solving for reserves, solving for assets, and everything else, they are not bluffing. Now, of course, everyone on this call is going to say, hang on a second, how do you go from a balance sheet this big to treasuries only? How do you reduce the balance sheet without causing some kind of volatility event in markets, this, that, and the other? Well, they're working on that. So it's certainly an aspiration, and they're not going to go out there and just resume QT just for a giggle. It's not about that. But what I try to flag here is that as much as it's difficult to see, given all the headline turbulence and press conferences and cabinet meetings and ridiculous tweets, there's some really, really joined up deep thinking going on, led by the politically empowered Mickey Bowman, who's just taken over as vice chair of supervision. And there's some really, really good strategic thinking going on between Bessent, Bowman, Myron, and many others across the Fed about what are we actually doing here. And it's remarkably joined up because it's just not about repo per se. It's not about treasuries per se. It's not about the lowest comfortable level of reserves, or LCLOR as the Fed tries to define it. It's about how does this all work together? What are we trying to do, solving for the most efficient operation of the ultra important US Treasury market? And again, there's all these people who extrapolate from that yield curve controls around the corner. All right, I'll just say I hope they're wrong. But the more important point, the less facetious point is there is absolutely no evidence whatsoever at the highest level that the Fed actually wants a bigger balance sheet. And I think that's important to reflect on. Now, going down into the weeds a bit, it is often said that because the Fed tells us so, there's a minimum amount of reserves that the system needs to work every day. And the recent plumbing congestion, repo conniption, everything like that proves that we've hit the lowest common level of reserves, and therefore the Fed needs to do QE or market reserve management operations, this, that, and the other. It's interesting that Myron has dropped that, by the way. He's learning by doing. But what if the reserves are actually too high, which is what's not often discussed? How is it possible that JP Morgan, and this is in the public domain, but you need to dig a bit, how is it possible that a systemically, I should say, important bank, JP Morgan, with all its payment obligations, all its repo, prime brokerage, all its balance sheet intensive activity, how is it possible that JP Morgan gets by with just $68 billion of reserves at the New York Fed, which is a lot less than its peers? And JP Morgan never has any funding issues, balance sheet issues, payment issues. It gets by on a lot fewer reserves than most people think, certainly a lot fewer than its competitors. And it turns out, and Mickey Bowman's been saying this, that part of the reason that banks, the big American banks, sit on such enormous reserves is not because they feel they have to, or not because they're trying to optimize their balance sheets or solve for some minimum number. It's because they've had all this regulatory guidance that you should keep a bit more than usual, when it turns out they might need a lot less. And there's a direct relationship between the reserves that the banks hold at the Fed and the asset purchases of the Fed. And without going too much further into the weeds, because believe me, this is complicated, there's a trade-off here that's brewing, and rightly so, where the Fed's going, hold on, what are we actually doing here? We've got the monetary policy side of the Fed. Is it not talking to the regulatory side, or does the regulatory side have too much power? And as Scott Bessent fairly says, are we trying to solve for reserves or assets or reserves? What are we doing here? And he's dead right. So it is emerging that the banks might actually not hold too few, but too many reserves. There's a transition afoot where the Fed under Bowman in particular is re-examining every part of the monetary function versus the regulatory function and finding a huge amount of inefficiencies. And combine that with leverage ratio reform, which has happened. And what's emerging is that the biggest US banks, should they choose to do so, may need less reserves and have the capacity to hold more treasuries on their balance sheet through time, which they probably will. And as you heard me mention at our meeting the other week, yes, the supply of treasury coupons has been curtailed as intended. So that's part of the reason the long end of the US curve has been so well behaved. You've had, I dare not say this out loud, you've had yield curve control not targeting demand, but targeting supply. It's actually very clever. But at some point...
It's about 75% of the issuances at the short end, right?
Yeah, but...
T-bills, basically, and other short notes.
Yeah, yield curve control via supply. You can do it. It buys time, but you can do it. But more to the point, thinking strategically, the big US banks are going to be given back the capacity to be more entrepreneurial with their balance sheet in a constrained way, which will likely include holding a lot more treasuries. And as much as the supply of treasury coupons has been curtailed, David, as you heard me say the other week, Wells Fargo was liberated from regulatory purgatory, which they deserved to go into purgatory, but they were liberated earlier this year. Sleepy old Wells Fargo has hired all sorts of high caliber balance sheet, treasury, and repo people from the rest of the street and other investment banks. It's actually very impressive. And this is publicly available data, but you have to dig. Wells Fargo alone has taken down approximately 25% of US 10-year note issuance in 2025. Little old Wells Fargo alone. So there's change afoot. It's not going to be dramatic. It's going to be incremental. But Mickey Bowman and Besant and all these people are looking into all of this deeply because it's all related. Reserves, treasury issuance, treasury repo, tri-party. Yes, the Fed's standing repo facility, is it fit for purpose? No, it isn't, because right now everyone should be using it and they're not. So what do we need to do to change that? All of this has been re-examined in real time, which is good news. There will be many people who say, oh, it's fiscal dominance, it's financial repression. No, it's common sense, and it's long overdue.
Great. Thank you, James. Fascinating insights. I knew that you would be just as impressive on this as you were when we met in Augusta in person.
Look, I think,
but let's, pardon me?
Let's not overstate that, because I'm not sure it's all true. But anyway, it's very. But look,
of course it is. You said it. It has to be true.
I mean your generous praise. Let's make an important philosophical point for our listeners. And quite frankly, the philosophical point I'm going to make is manifested in the returns you've generated for your clients. I mean, we sat down with a wonderful client of yours, had a good conversation about the world. That client gave you a mandate a while back, which was actually quite tricky, because 50% of that portfolio had to be in cash, and yet they expected you to generate a certain rate of return, which, by the way, you did really well. You did exactly the job they wanted you to do. But the point I'm making here, you generated the return for our family, friends, and your client, not by engaging in every conspiracy theory, in fact, avoiding them. You dealt in reality. You dealt in reality about inflation, about markets, about valuations, and you did a great job. And it's incrementally harder to be focused on reality these days, when everyone's shouting at each other, jumping up and down, hyperbolic commentary. And most of it is, to be blunt, crap. And our challenge is to be sensible, be proportionate, patient. And, it's okay to say we don't know. I mean, repo, the Fed's balance sheet, is a very complicated area, and a lot of people just talk rubbish about it, which is appalling. But there we are, to each their own. But we deal with these challenges in a proportionate way. We're trying to be less wrong. We're trying to stay in the game. But when it comes to the Fed, believe me, no one at the Fed turns up every day thinking to themselves, geez, how can I really screw this up? There is massive structural change afoot. It is change for good. We can rightly be concerned about who comes next after Jay and how dovish is that man going to be. That's all to be resolved next year. But from an institutional perspective, from a plumbing perspective, there is really, really good, long overdue work going on at the board in particular, and we should be cheering them on.
All right. Well, that's a good way to segue to Q&A. Now it's 6 o'clock your time, 6 p.m. London time.
I'm all good.
Yeah, we're going to skip this and we're going to go right to the Q&A. And I think Robert wants to, James, you must know Robert. I think vice versa.
Which Robert?
Robert Mullen. Sorry. Maybe he's.
Oh, yeah. Hey, this will be a tough one.
How are you, sir?
Hey, mate, good to see you.
That's right. I'm coming in with claws ablazing.
Oh no,
I know, not at all. I want to continue on the conversation we had down in Sydney a few weeks ago. And while I'm in general agreement with your premise that the overwhelming power of the monetary and fiscal authorities is a pretty tough tide to fight against. If you were to look at markets where you think the imbalances and positioning have accumulated in a way where, if there were to be a hiccup, whatever that might be, where might be the most asymmetric response? And really what I'm looking for is, ideas for where you might, as a collector of cheap convexity, where should we be looking?
It's just got to be credit, mate. It's got to be credit. And you knew I was going to say that. But for the benefit of the audience, look, if we expect US nominal GDP to pick up in the first half of next year, which I think is a reasonable bet. You got a little bit of, forget the Trump tax giveaway. There are rebates in the pipeline around the end of Q1. You've got a somewhat dovish Fed. It feels pretty good. But the point there is if nominal GDP is going to remain somewhere in the 5 to 6% range in the United States, then the economy as a whole is going to be probably generating more than adequate cash flow to service all its debts, which apart from some of the fringe element of the credit market probably means credit in aggregate is well behaved. But there's also a flip side. And that's why I think your question is very good. So for me, it's when I turn on the Bloomberg every morning, other than factor screens, as you know, and sector baskets and see what's happening there with momentum or lack thereof, I look at credit. And I think one of the untold stories of 2025 is how well behaved credit has been. So if I'm looking for convexity risk, a portfolio hedge that is relatively inexpensive right now, it would be something in credit. I won't get into too many specifics because it depends on the viewers or the listeners' appetite and there's some compliance reasons. But look, credit is where we look for the hedge. That's where the most convexity is.
Agreed.
So in other words, you would be short corporate credit and presumably lower quality corporate credit?
Yeah, I'd find myself. It's suboptimal, but it'd help one sleep at night. I mean, look, the credit professionals I work with can do all sorts of things in credit to reduce their exposure, whether it be in cash or synthetics or at the index level or tranches. There's all sorts of things you can do. But for the investor that doesn't benefit from an ISDA master agreement and CSA, you'd be watching like put spreads on credit ETFs, for example. If I started to see really, really large, unusual flow in that, I'd sort of go, well, hang on, something's changing there. I might see a bit of a gap out for some reason in levered loans. But quite frankly, if there was one QSIP I'd look at, it would be the paper of the recent massive Meta AI data center securitization. It's out there trading on Bloomberg. Well, it's trading everywhere. But it's out there on Bloomberg every day. The 2049 Beige Nets paper, or Beige Nets, I think it is, BEIGNETS, the 2049 stuff. And that's a real-time thermometer on, funding appetite for the data center stuff. So I'd be watching that. So credit, look, and to be clear, I'm not saying Oracle CDS or anything like that. Robert knows that. I'm just saying if we're looking for the top-down hedge on something's going wrong, on something or anything going wrong, the top-down hedge with the most convexity, for me, it has to be credit.
Great, thank you. And I would completely agree with David's earlier comments when he mentioned that for the first 15 minutes of your conversation here, I simply say, hallelujah, brother.
There you go. There you go. And you are, as we all know, my friend, you are extremely well placed to harvest that.
Patience. Right. Apologies, I've got to hop, but great seeing you.
Thank you, Robert.
Thanks for putting this on, David.
Who else do we have, Adam or Mark?
No one's raised their hand, but we have one in the chat from Jim Tigert. He asked, is FXY the best way to play Japan?
Well, that's maybe a tough one for James. So that's the Japanese yen ETF. You could argue about that. Certainly the better play in recent years has been with Japanese equities, which have actually done quite well. They've even done pretty well with the yen being weak. So it's a separation of the currency versus the stock market. It depends on where you're wanting to bet. The Japanese stock market still looks undervalued to me. It's not as cheap as it obviously was, but there's still bargains to be found over there.
Yeah.
And of course, they're Japanese exporters with the yen where it is.
There you go.
They're in great shape. I know that some of the big Japanese automakers like Toyota have major presence in the U.S., so they don't get the full benefit of the weak yen. But still, it's a major tailwind to the Japanese industrial sector. Would you disagree with what I just said, James?
No, I think why buy the derivative when you can buy the underlying? I mean, why not just buy the yen? That's the way I see it. And if you want a little bit more power on the back of that, why not buy the great Japanese companies, whether it be the trading houses or the exporters, that are probably going to be benefiting from both? So, yeah, I'd rather buy the asset than the derivative.
Good deal. Anybody else?
I think I saw another one pop up there.
Yeah, we got one more kind of dovetails off of what you were just talking about. David mentioned in his newsletter about not ruling out the possibility of the yen breaking out to a multi-decade high of 170 and more. How does James assess the chances of this scenario?
So James, just to be
Well,
clear, what I was warning about is that it
yeah,
better, from a technical standpoint, it better hold about where it is right now. Would not be great to see a new
yeah,
all-time low made in the yen.
yeah. I think it'd be very bad for Japan and very displeasing to Washington should dollar yen pop back up above 160. But happily, the probability of that, I mean, nothing has a zero probability in finance, believe it or not, but the probability of that is now very low. So I'm not concerned about that. A month ago, one should have been very concerned.
That's about what I
But
wrote down.
yeah, there you go. So no, I'm not concerned about us exploding back above 160. I think there's reasonable grounds to expect that the yen should be a bit stronger over the next month, and we'll see what happens after that.
Yeah, we really didn't fully get into this, but the conversation you had with Mr. Kuroda, and he was very public about this, as I remember from your various podcasts, that he felt this a couple of
Yeah,
years ago, he felt that the
yeah,
BOJ would ultimately get to 2%. And right now, because I don't think
yeah,
people quite appreciate, in Japan, you've got a policy rate at 0.5%, you got inflation at 3. So on short-term interest rates, you got a negative 2.5% yield, real yield. That just seems crazy. And I just don't think that.
yeah. No, I just for the background for our listeners and viewers. Just after he left the Bank of Japan, a little bit of a story to lighten the load a bit. Just after he stepped down as his 10-year run as governor of the Bank of Japan, Kuroda-san was in London doing some conversations. And I was fortunate to have dinner with him and a couple of mutual friends. But what was interesting about our dinner is that most of the people around our table, there were 10 of us, were not markets people. And there were like 3 of us from financial markets. And Kuroda-san's talking about the world and this, that, and the other. And we're like, yep, okay. And then he says, and if the Japanese economy evolves roughly as I expect, then over the period ahead, the Bank of Japan should normalize policy rates and take their deposit rate to 2%. And the 3 or 4 of us from financial markets just looked at each other like, what, did he just say 2%? No, hang on. Did he say that? Have we had too much port or something? I don't know. No, he meant it. And he's still saying it. Now, of course, it's Japan, so everything's a bit slower. But that, I think, is still the number they have in mind. Now, if and when they get there, I don't know. But I will say, frankly, that for the Bank of Japan to still have their policy rate sub 1% is absolutely absurd. And they know it.
Totally agree.
They know it. They know it's absurd. So they're getting their own way. It's been a really clever, sustained effort by the Bank of Japan over the past couple of weeks to get the rate hike in play this month. And now the market's assigning a very high probability to that, and rightly so. But David, where it gets potentially very exciting for the yen is if Ueda-san in particular articulates a reaction function. So not just, oh, ladies and gentlemen, thank you for listening. December the 19th, we've hiked our policy rate. This is why, any questions? But go beyond that and say, we have hiked rates and we think we're on a path to here. So it's hard to bet on any central bank that doesn't have a reaction function. I mean, we know the Bank of Canada, where they're at, the RBA, uncomfortably so, the Reserve Bank of New Zealand, even the ECB, the Bank of England, sort of. And we know the Fed is angling dovish. But the Bank of Japan sort of does something and then goes, well, we'll get back to you. It's frustrating, but that's where we are. So I'm hopeful on December 19th that Ueda-san has the confidence and the political cover to articulate something a little bit stronger. And by the way, if the JGB market settles down between now and December 19th, which is, I think it can do, it would help to instruct the politicians that a continual gradual raising of rates in Japan is actually good for anchoring inflation expectations and actually good for bringing the longer end of the JGB market under control.
Precisely. That's what I think is exactly right.
But that's a journey.
Markets are missing that.
It's a journey that they're on. They're not there yet, but they know that they've got more work to do.
No, things move at a glacial speed in Japan, of course, as you alluded to.
Yeah.
All right. Anybody else have a?
I think there was another one somewhere.
Yeah, I think we got the last one here. It says Jim's iPad. I think this might be Jim Edsall. Under the heading of capital-starved commodities, does James like U.S. oil and gas, E&P, or midstream?
So midstream are the pipeline operators, basically.
Just have it. Look, it's funny, isn't it? I mean, we can understand why energy well, let me rephrase that. Not energy, ex-gas, but we can understand why oil, et cetera, is looking a bit heavy right now. We understand that. I'll just say what intrigues me about energy stocks generically, ex-gas right now, is that the elasticity to the oil price and Brent price seems to have changed. And I can't tell you to the decimal point how the delta has changed. But often, not always, but often, the stocks will react in advance to a change in the underlying commodity. I don't know why, they just do, whether it be natural gas stocks, etc. They tend to change direction before we notice that gas is 5 or whatever.
That's such a great point. And it's happening today. It's happening now.
Yeah, so there's something changing, and it doesn't mean you rush in and have another couple of mouthfuls of a Chevron at 152 or so, or Exxon or Oxy, or it doesn't, but something's changing. And I bring that up because we've had this wonderful conversation this afternoon, evening my time, and what a pleasure it's been, David. But I like to believe my theories of how the world works are sensible and proportionate, and I'm trying to be less wrong and trying to be roughly right about all these things. But the only thing that matters is price. It's the only thing. And too much of the commentary out there is so wild and woolly and hyperbolic. And it's very difficult to reconcile it to price. So price is the only thing that matters. Price is how we keep score. Price is how we calculate NAV. And yes, price is how we accumulate capital, and price is how we get paid. And I bring all that up because if I think I have a robust theory of any asset class or sector or trend, and it's not backed up by price action in a reasonable period of time, I am wrong. But the flip side is also true. And David, you and I had a good discussion about this down south. Markets always tell you what to do if you listen. And I don't mean just looking at indices. I mean, if you look deep into the guts of global markets, no matter what people think about passive, although the work Mike Green has done is phenomenal. So I'm not disparaging Mike at all. I'm just saying, even with all the passive flow, the vol selling and everything else, markets always tell you what to do if you listen. And if correlations across asset classes are changing, that's one thing. If correlations within asset classes are starting to change, that's another. And if the correlation between mega cap oil and the underlying oil price is starting to change, I think that's notable and probably investable.
Excellent. Totally agree. All right, we better let you get to a nice. Well, I don't think you're having the strong stuff anymore. You're on such a very healthy diet.
I'm not entirely sure why I started to stop drinking 2 months ago, but it's something I do every year, and I do about 100 days a year, or roughly a third of the year off the booze and stuff like that. It's just a reset, you know. And as you and I discussed, David, it doesn't hurt to do it from time to time, and I'll be back.
Well, you're looking great.
It's very kind. If you could put that in writing on your letterhead, I'd appreciate it.
Okay, my friend. Thank you again. You've been so generous with your time, and especially as busy as you are, and wonderful insights. So I look forward to doing this again, and I wish you and your family a very Merry Christmas season. I know you're going to be with your family together right now.
Yeah.
Great. You're not going to be traveling all over the world for a while, so enjoy that time.
No, I've got a bit of time at home. Been traveling for 2 months, as you know, through October and November, and nothing planned until Abu Dhabi, where there's a lot of interesting people in the middle of next month. But look, it's been a pleasure getting to meet you and Jeff and Mark, and obviously hang out with our mutual friends down south. And look forward to doing it again, and look forward to more golf in 2026. And very best wishes to you, your family, and all your viewers and clients. This has been a treat.
Thank you, James. Thank you very much. All right.
See
Goodbye,
you.
everybody. Till the next time.